There's a quiet force working against your wallet every single day. And strangely, that same force is what makes a modest $35 weekly habit capable of outpacing what most people earn from a full-time job. Time erodes purchasing power, but it multiplies invested money. Grasp that contrast, and the entire picture of personal finance snaps into focus. In this video, we'll break down exactly how that dynamic plays out, what it means for your everyday budget, and how investing weekly flips the equation in your favor. We'll cover real cost of living pressure, the mechanics of compounding beneath all the market noise, and a curated set of Fidelity funds that keep building value even when the economy feels unstable. By the end, we'll walk through a complete Fidelity index portfolio that can transform a $35 weekly contribution into a portfolio approaching $1 million, one that throws off more than $8,000 every single month. But before we get there, let's talk about why weekly investing outperforms lump sum thinking for most ordinary people. The biggest reason people hesitate is that small amounts feel pointless. $10, $5. It doesn't look like it could move the needle. But that hesitation usually reflects the financial squeeze people are already living under. When the cost of living climbs faster than paychecks do, consistency stops being a virtue and becomes a survival strategy. It quietly compounds in the background while everything else feels like it's working against you. Groceries make this painfully tangible. Since 2020, food inflation ran at 3.45%, then 3.94%, then surged nearly 10% in 2022, before gradually cooling to 5.76% in 2023, 2.26% in 2024, and 2.45% in 2025. In practical terms, a $20 grocery run in 2020 now costs roughly $25.32. That's not an abstract number. You feel it at the checkout line every week. Borrowing costs have added to the burden. Federal Reserve data shows interest rates climbing from near zero in 2020 to around 4.09% by late 2025, making mortgages, auto loans, and credit card balances noticeably heavier. Meanwhile, wages have struggled to keep pace. According to the Economic Policy Institute's wage tracker, year-over-year pay growth sat around 3.8% in 2025, barely matching short-term inflation and well below the cumulative price increases since 2020. Then, there's the stock market, which has its own uncomfortable history. From the Great Depression to the dot-com collapse, the 2008 financial crisis, the COVID crash, and the inflation-driven sell-off of 2022, every major decline felt catastrophic in the moment. But when you zoom out, every single one of those downturns was eventually followed by a recovery, and the long-term trajectory has always pointed upward. Historical data consistently places long-run market returns between 10 and 11% annually, dividends included. This is precisely why weekly investing is such a durable strategy. You don't have to forecast inflation, predict market peaks, or time the bottom of a correction. When prices rise, your weekly deposit still goes in. When markets fall, your dollars buy more shares at lower prices. When the rebound comes, you benefit from every share you picked up during the dip. In a world that changes constantly, a steady deposit habit becomes one of the most reliable financial tools available. And here's where the broader point lands. If salaries grow 3 to 4% annually, but a well-constructed portfolio compounds at 2 to 3 times that rate, your investments gradually build towards something your paycheck alone could never reach, including passive income levels of $8,000 or more per month if you stay the course long enough. Once you accept that long-term consistency beats short-term timing, the snowball effect becomes easy to visualize. Take someone contributing just $20 per week, or $1,040 per year. A modest amount by almost any measure. In year one, contributions total $1,040, and with market growth and reinvested dividends, the balance begins to shift slightly. Nothing dramatic, but the foundation is being laid. By year three, total contributions reach $3,120, and the account balance might sit closer to $3,750. That gap between what went in and what the balance shows is the snowball beginning to take shape. By year 5, contributions total $5,200, but the portfolio could be worth around $6,850. Now, each weekly deposit falls on a larger base, and each dividend payment purchases additional shares that generate even more dividends. The early years aren't flashy, but they are the engine of everything that follows. The mindset side of this matters just as much as the math. Most people don't fail at long-term investing because it's complicated. They fail because the early results feel too insignificant to take seriously. You contribute $20, the balance barely moves, and your brain immediately questions whether it's worth continuing. We're built for quick feedback loops. When progress looks slow, the instinct is to assume the approach is broken. Market volatility amplifies this. A sharp weekly decline triggers alarm. A recession headline feels like a signal to pause. A volatile stretch feels like the wrong time to keep going. These reactions all stem from linear thinking, expecting steady, predictable progress from something that actually builds in curves. Markets move up and down on their way to long-term highs, and compounding works silently in the background through all of it. The real mental shift is moving from measuring outcomes week by week to measuring consistency over time. The question changes from, "Is this growing fast enough?" to, "Did I invest this week?" That single reframe removes the pressure of watching short-term numbers and replaces it with a habit you can actually maintain through good markets and bad ones. That consistency is ultimately what allows a portfolio to grow beyond what a salary can produce, not because you made brilliant calls, but because you let compounding run long enough to do the hard work for you. Once that thinking is in place, picking the right investments becomes far more straightforward. Rather than chasing the perfect fund, look for a consistent set of qualities that support long-term growth through changing conditions. These are the same qualities that make the following Fidelity funds a strong foundation for this kind of portfolio. First is diversification, owning a wide range of companies so that no single failure can significantly damage your overall position. Broad index funds handle this automatically, spreading exposure across hundreds or thousands of businesses without requiring you to pick individual winners. Second is broad market exposure, which means owning companies across different sizes, sectors, and styles. Markets rotate unpredictably. Some years large caps lead. Other years mid caps or niche sectors take over. Covering multiple categories keeps you positioned no matter which area is driving returns. Third is verified historical performance, meaning funds backed by companies with genuine earnings growth and strong underlying fundamentals, not momentum or hype. Fourth is dividend growth, because companies that raise their payouts annually create an accelerating compounding loop, each reinvested dividend buying more shares that generate more future dividends. Fifth is low fees, because even a fraction of a percent in annual expenses compounds into a meaningful drag over decades. The first fund is FZROX, the Fidelity Zero Total Market Index Fund. It serves as the core position, tracking the entire U.S. stock market across large, mid, and small cap companies with zero management fees. It currently yields 1.04%, grows its dividend at 7.55% annually, and has delivered 13.5% in average annual price appreciation. It covers the whole market and builds steady long-term value without unnecessary cost. Next is FSMDX, the Fidelity Mid-Cap Index Fund. This fund targets mid-size companies, businesses large enough to be financially stable but still agile enough to grow rapidly. It holds roughly 300 companies across technology, industrials, consumer sectors, and finance. It yields 2.42%, grows dividends at 17.21% per year, and has produced 7.4% annual price appreciation, capturing the expansion phase growth that large-cap-only funds often miss. FITLX, the Fidelity U.S. Sustainability Index Fund, adds a forward-looking dimension. It holds companies screened for strong environmental, social, and governance standards, with significant concentration in technology, healthcare, and communications. It yields 1.14%, grows dividends at 13.74% annually, and has posted 13.06% in yearly price appreciation. It brings exposure to sectors that have shown strong structural momentum over the past decade. FGRIX, the Fidelity Growth and Income Portfolio, provides balance between income and appreciation. It focuses on high-quality, large-cap companies with stable earnings histories, blending reliable dividend payers with consistent growers. It yields 3.13%, grows dividends at an impressive 19.68% annually, and delivers 8.17% in price appreciation. It lifts both the income and growth components of the portfolio simultaneously. Finally, FDGFX, the Fidelity Dividend Growth Fund, acts as the income anchor. It concentrates on companies with long records of dividend increases and strong financial health, prioritizing stability over aggressive expansion. It yields 3.2%, grows dividends at 18.03% per year, and offers 2.78% in price appreciation. Its role is not to generate the highest returns, but to steadily reinforce the compounding power of dividend income through all market conditions. To calculate the portfolio's average metrics, we use a simple equal-weighted approach. Adding the 5 dividend yields, 1.04%, 2.42%, 1.14%, 3.13%, and 3.2% produces a total of 10.93%. Dividing by 5 gives an average portfolio yield of approximately 2.19%. Applying the same method to dividend growth rates and annual price appreciation figures, the portfolio averages a 15.24% dividend growth rate and 8.98% in annual share price appreciation. Together, these numbers describe a portfolio that grows in value while simultaneously increasing what it pays out each year, two forces compounding on top of each other. Now, let's put this into a real projection. Meet Josh. He contributes $5 a day, which adds up to $35 a week. With 5 funds in the portfolio, that works out to roughly $1 per fund per day. A small amount by any standard, but small and consistent, is exactly the combination that compounding rewards most. At the end of year 1, Josh's total contributions come to approximately $1,825, establishing the base for everything that follows. By year 10, the portfolio is projected to reach around $32,000, with reinvested dividends beginning to contribute meaningfully to growth. By year 20, Josh will have put in $36,500 of his own money, but long-term compounding pushes the portfolio to roughly $160,000, generating close to $9,000 per year in dividends. The final decade is where the numbers become striking. By year 30, the portfolio is projected to reach approximately $942,000, generating around $98,000 per year in dividend income, which works out to more than $8,000 every month. When you look at the full picture across those 30 years, Josh will have contributed $54,750 from his own pocket. The portfolio will have grown to 17 times that amount. Subtracting his contributions from the projected total leaves roughly $887,250, created entirely by compounding, reinvested dividends, and decades of consistent market participation. The overwhelming majority of his future wealth will not come from what he put in. It will come from the portfolio running on its own momentum, and at that point, his investments will be generating more income than many full-time jobs, all from a habit small enough that most people would never take it seriously in the first place.